Hey, good afternoon, everyone. So, during next 30 to 40 minutes, we'll try to understand generally what are the common mistakes most of the stocks or options traders make. Right? We'll start with options trading. Right? In stocks trading, the risk is less, but your return of investment will be also very less. Whereas in options, your risk is high, but your return of investment also will be high. So, first thing is you need to understand what type of trader you are or what type of account profile or risk profile you have. So if you are more of a trader who want less risk, low returns, then maybe stocks trading is more better for you. You are a trader who are a more of a high risk profile trader. Options trading is good for you, where you can take bigger risk, you can also make bigger profits. So understanding that is first most important thing. Second thing is within options trading also we have different things, right? You can be a scalper, you can be a day trader, you can be a swing trader. For example, let us say you are a busy professional, you have a lot of meetings every day, right? Suddenly you take a trade, suddenly you get a call, you get into a meeting. By the time you come out of the meeting, already it might have made 50-60% up and suddenly it might have went down. So you have to, based on the nature of your job, if you are more of a busy person, you cannot focus on your trades, you only look for the swing trades. Right? For example, we have two types of channels where one is the earnings channel, which is more like a swing trade. You take today, you close tomorrow. Right? You don't need to immediately take the trade. If I give it 2 or 2:30, you can take any time between 2:30 to 3. Then you can close the trade next day morning. In the same way, if you are more of a day trader or a scalper, then the SPX trades and DX trades which we take, or they are more of the same day we try to close them. So based on that, if you type of nature of job and whether you can focus, whether you can take enter and exit on time, whether you can join the live sessions, based on all those things. If you are more of a busy person, earnings channel is more better for you. If you are more of a trader, right, who is working from home, who has very less meetings, you can take care of your work either before the live sessions, after the live sessions. Then you can do SPX, NDX, Tesla, Nvidia, all those trades. So that is number one point, because that is where many traders will not be either they enter, they are not able to exit on time, or they miss some trades and they enter after already it moved 20-30%, 40% up. So don't enter a trade if already it moved so much. Don't enter, right? Because why we give more alerts also, because you will be busy. If you miss one trade, you can enter the next trade. Don't try to enter a trade already if it already made a huge move. The second thing is generally for options trader, generally for earnings, one common mistake made by many traders is they only look for well-known companies, right? For example, if we give some four earnings alerts, only if you know the company name like Tesla, IBM, or Microsoft, Amazon, they take only the trade. If there are another three earnings trades on the day, but you don't know much about the other companies, you only know about Microsoft, you only take the trade, suddenly it can. If only Microsoft is giving loss, all the other three trades are giving 100% profit. That is the another major mistake, which especially, right, this is mainly for options trading. For stocks, I understand if you want to buy good company stocks, that is good, right? If you want to only focus on Microsoft, Amazon, Google, Tesla, Nvidia, that is a good practice. But for options trading, sometimes you have to take, right, especially for earnings, right? Because the when the small companies are showing lot of negative factors with all our indicators, then there is much more higher chance of success. So that is one more thing everybody need to follow, right? I'll open up for Q&A later, but so first thing is understanding what type of trader you are, whether you are a day trader or a swing trader. If swing trader, focus on earnings alerts. If you are a day trader, you can focus on the trades when you are only free for next 1 hour, then only you take the trade. If you have a meeting within 15 minutes, don't enter a trade. Second thing, don't, right? Again, if you're a stocks trader, avoid um, avoid stocks buying at a much premium prices, right? Again, by looking at last 1 week, how much the price moved. If already it moved 10%, 20%, 40% up, then don't enter a stock. Don't enter with a don't enter with FOMO, or don't enter with emotions, right? Because generally what tend to happen is we buy stocks at a higher price. Whenever we buy it, it will go down. Whenever you take a stop loss, it will go up. So always better you wait for the reversals. So again, there are different indicators which will help us. But again, our session objective is for options trading, don't neglect any tickers. For stocks trading, you can mainly focus on the well-known companies. If you are a stocks buyer, you can focus on good companies which are known, because even if market goes down today, right? Last 1 week it went down. But again, next 1 2 weeks, there might be a big bounce. If there is a good there is a huge red day or huge drop on good stocks like Amazon, Meta, Netflix, then that is the day where you can do some dollar cost averaging, add few positions. Right? If you want to invest $1,000 every month into some good company stocks, you buy one Netflix stock, or you buy one Tesla, you buy one Nvidia. Like whenever there is a red day, that is the best time to buy. But generally what we do is we do opposite. Whenever it goes so much up, we buy at the top. Whenever it goes so much down, we get panic, and we don't buy it. And again, it goes up. Next 1 week, it will move 20% up. Nvidia from 140, it came to 108. We get panic. We sell off. Whenever you sell it off, again, the next 1 2 weeks, it may go to 130, 140. Right? Let me quickly share you so you'll understand clearly. So especially, right, if something is close to the bottom, right? For example, right, if you are a swing trader, we have to mainly use 1 hour time frame or 4 hours time frame. Generally, whenever it goes to the top of the channel, that means it can drop. Whenever it goes to the bottom, right, it came all the way to the bottom of the band. That means it is oversold. Now it will try to go up. So you wait for these type of points. Now it came all the way down, right? You got a buy. Again, it did a retest. Now we got another buy. So here, if you see, now this is a good time, right? If you are a long-term trader, or if not a long-term, right? Swing trader. That means you want to hold for 1 week, 10 days, 2 weeks, 3 weeks, like that. Then hood is at a nice price now. Let us look at MSTR. MSTR also, it came all the way, right? It went all the way to the top. So whenever something is in between, you avoid it. Now this went all the way to the top, right? Around $420. It went out of the band. You got a strong sell signal. T5 also went all the way to the top, gave a sell signal. So that is where you can either buy the puts for leap, right? After 3 months, 6 months, you get a $250, $300 put, which you may get only for $1 or 50 cents, right? When price is around $400, if you are buying a 300, $350 put, you will get it much. It went all the way to the top of the band, and you have to get a sell signal. Then you can see that price came nearly all the way to bottom of the band. right? It came all the way to $310. It went further. So whenever it comes to the, again, it went up to nearly 340, 350. Again, it touched the midpoint and again it dropped. So whenever it comes to the bottom, generally it will try to go and touch the midpoint. So again, you need to look at confluence with other indicators also. You will not just go with one indicator. But what I'm trying to tell you is always you wait, don't trade in between. Wait for a bottom to go to get the calls or to do bull put spreads, or wait for it to go all the way to the top to do bear call spreads. If it is somewhere in between, you can avoid it taking the trades. If you want to buy stocks, now MSTR can make a nice move this week. Hood can make a nice move in the coming week. So that is one more thing, right? We always try to buy when MSTR goes to 400, 500, we get tempted, we buy at a top. Suddenly, so right, we don't look at all the confluence, all the factors. We buy at a top. That is where generally we tend to take a risk. But if you are buying at a discount, so if it is at the bottom, that means it is at a discount price. If it is at the top, that means it is at a premium price. You try to sell here, you try to buy here at the bottom, whether it is futures, stocks, whatever it is, right? If you are a stocks buyer, you will buy the stocks whenever it comes to the bottom and starts moving up. If you are a options buyer, right, whenever it goes to the top and starts dropping into the inside, that means it will come all the way, touch the midpoint. You will try to do puts. You will try to buy puts for next 3 months like that. So that is another major important rule we need to follow. Always buy at a discount, buy below the band, sell above the band for stocks. Buy the option calls or leaps, right? Leaps means 6 months, 1 year later. You do that. Either you can use if you want much bigger profits, you do in the daily time frame. Or right, if you want to hold only for 2 to 3 months, you do in, or 2 to 3 weeks, you do in 1 hour. If you want to hold for 3 4 months, you do in daily. If you want to hold for a year or more, you do weekly, right? If weekly, if it comes to the bottom, that is a perfect opportunity to buy the stock. Even weekly, if it goes all the way to the top, right? Let us look at Tesla. It went all the way to the top. Then it started dropping inside the band. So that is where, right, whenever it is at the top, you got a confluence from T5. That is where generally we can buy the puts. Whenever if it goes all the way to the bottom, that is the best time to buy calls, right? Calls for next 1 year leap or like that. So I'll be doing more swing trades from tomorrow. But again, if something is in between, you can ignore, right? Either at the bottom, long position, at the top, short positions. Then let me explain you one more thing where right, the major mistake done by most of the users are, right, again, I'm also not an exception. We all make those mistakes. So I'll take some examples. Right, let us start with stocks. Right, let us just take an example of somebody, Mr. Mr. A has 50,000 account, right? He is a low risk trader. He wants to mainly go with stocks. If you are a stocks trader, you divide account by 20 parts, or you can do it by 25. That means approximately 4% for each stock, because you never know, some stocks can be manipulated. right? Suddenly, because of some news, stock can go so much down. So never put more money, even though you may like Tesla, you may like Nvidia, you may like Amazon, whatever it is. Any stock is can be manipulated at any point of time with some news or other things, right? So only use 4%, right? If you have a $50,000 account, divide that into 25 parts, which is 4%. 4% of 50,000 is approximately $2,000, right? So $2,000. That means, let us say you are buying Nvidia at, let us say, $110 or $120. Now you will try to buy approximately 16 stocks, right? Just you go calculate. So it is approximately 16.66. That means you will only buy 17 stocks. Let us say you want to buy AMD. AMD went so much down, so there is a possibility for a reversal. Let us say AMD is around $100, right? Just for example, you will buy 20 stocks. Let us say you want to buy Tesla. Tesla is at $250, right? Again, why you will buy? Because let us say Tesla came all the way to the bottom in 1 hour, right? You got it came all the way to the bottom. It came to the bottom completely, to the bottom of the band from nearly $480, right? If you see, right, avoid all the noise in between. Only see at what time it went all the way to the top of the channel. Here, this is somewhere it went to the top of the channel. That means that is overbought area. Okay, right here, you can see that it went all the way to the top of the channel. This also went all the way to the top of the channel. We got a strong sell signal. So that is the best time where you have T5 confluence, where you have reversal confluence. You take puts, right, for next 6 months, right? After 6 months expiry, you take puts here whenever you see a strong sell signal. One is the first rule is it should go out of the band, out of the top band, right? If you do zoom out, you see that, right? It went all the way from the bottom to the top, and you got a strong sell, right? You won't, whenever it goes out, you won't take it. You have to see a strong sell signal. And now you are buying a 350 put, 400 put, something like that, right? You can also see what is the midpoint value around that time. If you see what is the midpoint value around 410, if you buy 410 put when it is 490, you will get it for $1, $2. But you are buying it for next 3 months, 6 months expiry. Then if you wait for 1 month or so, that will make nearly 300, 400, 500% on returns on your. It came all the way from the bottom to the from the top to the bottom. You will make huge profits. Same thing, right? For long also, whenever it goes all the way to the bottom, look where is the midpoint and get a call for 3 months, 3 to 6 months expiry. Then again, you wait. You don't need to take in a hurry, and you can wait for, if you have patience, it will make huge profits. So that is the strategy. But whenever you want to buy stocks or whenever you want to buy options, what you need to do is understand what is your account size. For if you have a 50K account, your stock portfolio, you want to use $50,000. And then if Tesla is at $200, let us say, or $250, right? You want to only use $2,000 as a standard amount. So maybe you may buy some 8 stocks. Like that, if you may, or let us say SOUN. right? If you go to SOUN, it is a good company, but again, nothing will keep going up, right? Everything will go to a point and then they will drop. If you see SOUN, you see at one point of time it went all the way to, right? It went all the way to the top of the band. And then you got a strong sell signal. Whenever it goes to the top of the band, you get a strong sell signal, you take puts. Then from nearly 24, $25 within 1 month, now it is at $8 or $9. Right now it came all the way to the bottom. Whenever it is a bottom, you get a strong buy. You can get minimum 10 call, 12 call, 14 call like that, or you want to buy the stock. SOUN is at around $10. Right? You buy some 200 stocks. Like that, always use a consistent amount for your purchases. Right? Don't, right? The most common mistake every trader will do is, okay, I buy 100 Tesla stocks. I buy 100 Nvidia stocks. I buy 100 Tesla or AMD. I buy 100 SOUN. Suddenly, only SOUN is moving good, but all these went down, right? Or let us say Nvidia moved up, AMD went up, SOUN went up, but Tesla dropped so much, right? So your investment is $12,000. AMD, right? Let us say you bought 100 stocks each, right? AMD at $100, Tesla at SOUN at $10. So I'll explain both the scenarios so that you will understand. So in one case, you bought 17, 28, 200. So your investment is $8,000 here. Whereas here your investment is, you are buying 100. Here you are buying, now your investment became 48,000. So here your investment is 8,000. Even if one of the stocks further drops, your risk is minimal. Here you used all your account. Suddenly, because of some Trump tariff news or something, it went further down. Then your account suddenly becomes 40% down, 50% down, 60% down. Suddenly it can go into margin account because of one bad news, two bad news, right? For 2, 3 weeks, it can go so much. So you will lose your sleep, you will lose your patience, you will take stop loss. But here you don't worry, because even though, right, even though two stocks, 2, 3 stocks went up, one stock went down, you are green here. But here SOUN went from $10 to $11. AMD went from $100 to, let us say, $105 or $101. Nvidia went up by some $2. Let us say Tesla went to $10 down. So or let us say Tesla went $15 down, or just for some example, right? $20 down. 23 or $230, from 250 it went to $230. right? Even though you have three success, because just one stock, right? Oh, you have 75% success, but your position size is not correct. You will be still making loss because you used a consistent quantity. So consistent position size is not consistent quantity. It is same amount. So this is the key which everybody need to remember. When we say consistent position size, it doesn't mean that you have to buy 100 stocks for everything. Now, even you had 75% success, but because just one stock went so much down, even other three stocks went up, you are still in a big loss. But when you use a consistent amount instead of consistent quantity, here you use 17, 28, 200. Even though two or three might have gone down, if one goes up, you will make nice profits. So this is a key for every stocks buyer. Now let us take an example of options, right? So which tickers next week we have? Let us say we have XPEV. Uh, so we have earnings for XPEV on Tuesday morning. Now we can do different things. We can buy naked calls. We can buy naked puts. We can do bull puts. We can do bear calls. Four different ways we can make money. Right. First thing is let's go to XPEV and see how XPEV is looking. Okay. If I generally for earnings, we always need to look into the daily time frame. So what do you think can happen to XPEV by looking at this? Right. You can I enable the chat comments. You can post your comments by looking at this. Do you think XPEV can go much further high or go down? Right. There is a high possibility for a down. So now let me so by looking at this, right now you look at what E5 is telling, what price pulse is telling, right? From nearly $12, it went all the way to 20, 24, $25. So where there is a high possibility, right? There is 95% possibility it will drop, right? Because it is overbought. You can see here, it is completely highly overbought. You can see sellers are trying to bring it down, buyers taking it up, sellers bringing it down, taking it up. So there is very, very high possibility for a big drop. Now, okay, now I will go here and I don't want to buy naked calls. I don't want to do bull puts. Two things are gone now. Now let us say I have a $30,000 account for options. Now I don't want to even buy any stock for XPEV because I see that it is already overbought and I don't want to short it also because shorting stocks is high risk. If it is looking bullish, I can buy it. But if it is looking bearish, I don't even buy that XPEV stock. So I don't buy XPEV as it is overbought. Now, but I want to take advantage. So now let me, okay, what is the current price for XPEV? XPEV is around $24. So if I take an example, Yeah, let me open my Thinkorswim and share you with some examples so you can understand it much better. Oh, okay. It's taking time. Share. Okay. So let us say, okay, I want to buy XPO puts for the coming week because I see that it is bearish. I want to buy maybe, let us say, 24 put for 321. So my account size is $30,000. So always I need to use maximum 3% because options has more risk compared to stocks. On stocks, it is okay for 4 to 5% for every trade. On options, generally you use 3%. 3% for each trade. So 3% for each trade is approximately $1,000, right? That means on every trade you can use 1,000. So I want to do two trades for XPave now, right? So if puts are approximately at $2, right? This is an approximate amount. So what do you think how many contracts I can take? The option premium is $2. Okay, yeah. Someone mentioned 23.5 put is on 1.2. Let us say 23 put is $22. So your maximum amount, right? 30,000, right? If you have 60K, that means you can invest $2,000. If you have 30K, invest 1K. If you have 10K, right? 3% of 10K, use $300. Like that, just right. If you have a cash account, you have a $10,000. Just divide it by 3%. Don't use more than 3%. So naked puts, let us say 23 put is at $2. Then if 1K, that means my contract size is 5. I'll only buy 5 contracts. Let us say there is a bear call where I can sell 26 call or sell 24 call and buy 26 call, right? Because I am 95%, because one reason is it already moved so much from the previous earnings, right? In the previous earnings, it was around $10, $11. Now it is $26. Generally, earnings is a major event where it can move another 20-30%. 90% of the time, if there is already a huge move, one is my price pulse is telling that I am already at a premium zone. Even though I don't see major sell order blocks, I see that we are at a premium. Second thing, my reversal is telling me that I am already went all the way to the top of the band, right? I was somewhere at the bottom here. I already went all the way to the top, much higher from the top of the band. That means it already moved so much. Then if I look my delta still, yeah, I see that it is still positive. But yeah, we have until Monday also. On Monday, if we see that more sellers are stepping in, that will give us more confirmation. But my expectation is that maximum it may go, even if it goes, it may go another $1, not more than that. So if I go and do something, right, I see a lot of, so if I go and do sell either 25 call and buy 27 call, that means and collecting, let us say $100 premium, just for example. I am selling 25 call, buying 27 call and collecting $100. So what is the risk here? If it goes much higher, my risk is uh, so what is the difference between both the spreads? That is a $200 spread, right? Risk is 200. And what is the credit you are collecting? Credit is $100. So already you are taking $100 because you are bearish. You are thinking that, or our assumption is XPEV may not go above 25. But again, there can be always a 10% chance. 90% it will stay below 25. 10% chance it may go much higher. So I am selling a 25 and buying a 27. This is like my insurance. What? So my risk is $200, but I am also collecting a credit of $100. So my net risk is $100. So total spread risk is 200. But already I'm collecting a credit of 100. So my overall net risk is 100. So now I can take, that means I can take up to 10 contracts for this because my maximum I can allow $1,000 for every trade. So here, because it is a $200 spread or $2 spread, and $2 means for 100 stocks it is $200. But I'm also collecting a $100 premium because I am selling a call. So because my net risk is $100 for every contract, I can buy 10 contracts. Here my risk is $200 for every contract. I'll buy 5. Now if it goes down, if it goes so much down, I'll make huge profits with this. If it stays below 25, all that 100 dollars on 10 contracts, that is nearly $1,000 profit. So now your risk is very, very minimal. But let us say, right, you have some. Now, one more thing I can also do is debit spread. Buy 25 put or buy 23 put and sell 26 put. So $2 minus $1 is equal to $1. So what I'm doing, debit spread means I'm also buying a put because I know it is bearish. But also, again, I don't want to risk all the $200 on the trade. So I may buy at 23, I may sell at 25 put. So that I also have a protection hedge. So I am paying $2 or $200 for every contract, and I am collecting $1 for selling the 25 put. So if it goes now, you can buy 10 contracts for this. So if I'm doing a naked call or naked put, because the cost is $2 or which is nothing but 200 for each contract. So I will go with 5 contracts. If I do a bear call spread, right, because I'm bearish for XPEV. So what I'm trying to do, I see that it is somewhere close to 23. I'm going little bit above, selling a 25 call and going little more above and buying a 27 call as an insurance. So my net premium is $100. So I will go with 10 contracts. The same way I can do a debit spread also. So this is high risk and high return. If it suddenly drops to $20, you may make 500, 600% return on this. These are like low risk, low return. Even though it drops 10.10, right? From 24, it goes to $14, $15 also, you will make only whatever is the credit you collected, only you will make that. Here also it drops so much, whatever is the credit, you will only make that much. But your risk is less. So your risk is instead of right here, your your risk is $100 risk. Maximum you will lose $100. Here also maximum you will risk is $100. Here your risk is $200. You can make more, or you can also lose entire 200. So now based on the right here also $200, but you collected $1 premium, so your $100 is. So you buy 10 contracts here, or 10 contracts here, or 5 contracts here. So if you are a high risk trader, right, or you don't have a 25K account, you cannot do spreads. You will do 5 contracts with a naked put. You are more of a right, you have a 50K account or 100K account, you can do spreads. Then these two are best for you, right? So this is where you are not taking too much risk, or you are not taking too less risk. This is good for you. So this is lowest risk, this is highest risk, this is medium risk. Whether you want to do debit spread or you want to do a bear call, right? This is like a credit spread. This is like a naked put. If stock stays exactly at 24 itself, you will lose money. But if it stays at 24, you will make money here, you will make money here. You will lose here. So here, only if it drops big, you will make full big profits. You have high risk, high reward. It can make 500%, 1000%, right? There are some, right? Last week we took docu. It make 600%. We took MDB. It made huge profits. So based on what type of trader you are, based on your account size, if you can see like, okay, this is the spread difference, right? This is a spread difference. So my total spread risk is $200, credit is $100. So my net risk is 100, and I can only spend 1K for each trade. So, okay, if I am taking this trade, I will get 10 contracts. If I am taking this trade, my risk is 100, I will get 10 contracts. If I take this trade, $200, I will go with 5 contracts. Now, when you win 7 or 8 trades, 9 trades, and there will be some trades which will make 100%. There will be some trades which will make 400, 500%. Now you are using only $1,000 for every trade, right? So if I go here, if I am doing this, right? Let us say I spent 1K here. I spent 1K here. I spent 1K here. I spent 1K here. I spent 1K. Right? Whether I am doing a calls, bear calls, bull puts, whatever it is, I am spending 1K is my investment. Suddenly, this particular uh, MTN, I made 1K, right? The complete credit I got 100%. RDW, that made nearly 300%. So from 1K, it made 3K. For FCell, it is nearly break even. For Groupon, I lost 1K, right? Minus 1K. For Zim, I made nearly 1.5K. For West, we made nearly 1.5K. For S, I lost complete 1K. But for Docu, I made nearly 5K or 4K, let us say 4K. So when you are investing the same amount, your total investment is, let us say, some $15,000. Even if you lose 2, 3 trades, one trade covered all those 2, 3 trades. Then other 8 or 9 trades made huge profits. So your risk will be minimal, right? When you are using a consistent position size, because there will be some trades which will make you can keep 100% of the profit. So if you see here, we made nearly 90% success, right? There are HPE made 400, 500%. Hypo made 100%. Macy's made gains. KR made gains. CBRL we are still holding. FSM made, right? MDB made nearly 1000% profit. So that means one trade will cover nearly 10 losing trades. just one single trade. So when you use a consistent position size, your risk is very, very minimal. But if you are buying 10 contracts or 20 contracts for everything, right? Let us say you bought 20 here, 20 here, 20 here. Suddenly stock stayed at topping or it went up. Even though you may make profit here, you may lose big money here. So it is very, very important for each of you to understand what. So let us take one more example. Okay, let us look at five or something. Okay, what do you think five, right? Do you think five can go up or go down? Oh, sorry, you're not seeing it. Okay, now I think you can see. So we have earnings of five in the coming week. So there is a high possibility for stock five because it came all the way, it went to the top, it came all the way to the bottom. It is like oversold now, right? You can see all positive green, 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 green. So T5 is telling it will go up. In the here in the price pulse, you are at a discount zone. You are where the big companies may buy. Now let's go to our reversal indicator. If you go to reversal indicator, it came all the way to nearly close to the bottom. So there is a high possibility for 5 to move up. So now again I do the same thing, right? So when is it? 5 is on Wednesday after hours. I can do these three things, right? I'm bullish for earnings because it is already oversold. I can see a lot of possibility for it can go up. So I see that it is around $72, $73. So let us say I want to buy. Okay, now I'm going to 5. So let us say I want to buy 5 calls. So for example, I want to buy 75 call for 5. So naked calls. So current price is 72 or somewhere around 72. So how many contracts you want to buy? 75 call is around $4, right? $4 or $4.5. So now I'll buy only two contracts because my maximum capital is $1,000, 1,000 for each trade. So I'll only buy two contracts. Let us say now I want to do a debit call spread, right? I want to buy 75 call and I want to sell 80, 80 call. So that, right, I'll go here, buy vertical. I am buying 75 and also I'm selling 80 because I don't want to, $450 is a big amount for me. I don't want to invest 450 because if I see a nice big buy block, I will be full confident. I see that it price went so much down, but I see only some big buyers here. So instead of investing all $450, I may think like, oh, this is little risky trade. So what I'll do, I'll buy 75 call and sell 80 call. So my risk is limited now. So instead of 4.5, I pay 4.5 and collect 2.5 or whatever it is. So I 75. So now my from 4.5, my investment is only around $2 now. So collect 2.5. So my net payment I'm paying is only $2. So I can go and buy five contracts. So if its stock goes above 75, stays below 80, I have a huge potential. If it stays around 78, 79, I'll make nice profits. If it goes much above 80, still I'll make some nice profits. Right? Even though it goes to 85, 90 also, I have a limited profit. I can also do a double put. I can go here. I can do. I can sell a 75 put. Right? I can go buy or sell spread, sell vertical. I'll sell 75 and buy 70 put, and I'm collecting some $2.25. So sell 75 and buy 70 put and collecting $250. So what is the difference between both? The risk is $500 minus what is the credit I am getting? $250. That means my net risk is $250. That means I can go with four contracts. If I am doing bull put, I will go with four contracts. So even if it stays above 75, all that $1,000 is mine. If it stays between 75, 70 also, still I'll make profit. If it goes below 70 also, my risk is limited. So this is the low risk strategy. You will also make, so if it, because I see that it is already too much down, there is a high chance for it to go up. But you don't get 10 contracts here, 10 contracts here, 10 contracts here. You see, okay, this is my risk. This is my credit. My net risk is 250. So 250 for $1,000 is my 1K for each trade. So if I want to do a bull put, I'll go with four contracts. If I want to do a debit spread, I'll go with five contracts. If I want to buy a naked call, I'll go with two contracts. Then your risk is minimal. Right? If you are doing 10 here, 10 here, your risk is becoming much, much higher compared to your account size. Right? Generally, that is the common mistake most traders do is they take a fixed size every time for every trade. So let us say you made profit here, but you lost here because here you are investing 4,500 for 10 contracts. Here you are only investing $200. That means 2,000. Even though you made nice profit here, some 20, 30, 40%, 50% profit, you lost full, right? You might have win another 7 or 8 trades. But here you lost big, right? Because it is a huge size contract, $5 or something. You lost. Then all your profits are gone with one trade. But when you do this, okay, this is my account size, 30K divided by 3%. That means 1K for each trade. And then, okay, this is my premium for the call. Then I'll buy 5. This is my net risk for the spread. I'll buy 10. This is my net risk for the debit spread. I'll buy 10. This is my net risk for the debit call spread. I'll buy 5. This is the net risk for my bull put spread. I'll buy 10, right? Or 4. So if you can just follow this approach, you will be very, very highly successful. At the end of the week, you will see some nice profits. But if you are just going with 10, 10, 10, 10, 10 for every trade, whatever we give you, you go with 10, 10, 10, 10. You make 7, 8 profits, one big loss will take away all the profits. All your profits are gone. Right? Let us say SPX trade. Right? So let us say we are doing 55, 60, 55, 65 bull put. That means and collecting $100. So that means your risk is 500 because there is a 5 point difference. Right? Spread risk is 500 due to 5 point difference. Credit is $100. So net risk is $400. So now if you have $1,000 for each contract, now you will buy two or maximum three, right? Two to three contracts. If you have a 30K account, if you have a 60K account, you will buy 5 contracts. If you have a 100K account, you may buy 10 contracts. Now, when you make 8 or 9 out of 10 times, we generally win 8 or 9 times our SPX and DX trades. So you lost only that $1,000. But every time you are buying 10, 10, 10, 20, 30 contracts, suddenly your risk will be much higher. So based on your account size, if you take the trade, you are risking only 2 to 3 contracts for that particular trade, right? Based on your account size. If you have a 30K account, right? Let us take one more trade. NDX or SPX 5600 put 56 5610 put 5600 put, right? We are doing a bull put and you are collecting $200 premium. That means spread risk is $1,000 due to 10 points difference. Credit is $200. Net risk is $800. So I'll go, if I have a 30K account, I'll go with one contract, right? Or let us say I'm buying a SPX call at $10. I see that we are nicely ahead, right? SPX is looking very bullish, right? Already Friday it started moving up. So if you go to daily, what do you see in daily? It came all the way to the bottom, right? You can see that there is $2.7 billion buy orders here. It touched the, so there is a possibility for potential to go up, right? Let us say that you all already got a green, or let us say you are in a 1 hour time frame. You see that, right? It came all the way, right? You can see how it came all the right. Last week it went so much down. Then consolidation happened. Then suddenly buyers took the control on Friday. You can see nice move up. So tomorrow also it can continue. So now we can do SPX bull puts. We can do SPX calls. So now let us say you are buying a SPX call at $10, right? What is SPX currently now? Around 56.38. SPX 56.45 call at $10 tomorrow morning. Then because it is $10, right? Then you will only buy one contract. So if it goes to 46.60, this will make $25 profit, 150, 200% profit on this, right? Here, you will only make the $200 profit, right? Whatever you collected, only if it continues to go up, right? You went much below, you did a bull put spread, right? Because you see that in 1 hour, we are bullish. It started moving up. There is a high potential for it to go further up. Let us say, right, it may go all the way to somewhere to 57.20. Right, it came down, started going up. If it breaks this resistance, it can go all the way to minimum 50, right? This 57.20, 57.30. So if you are a low risk trader, I'll go much below here and I'll do a bull put because I see buyers here. I can do a bull put, so I can keep the $200 profit as long as now it is at 56.40. It is bullish. If I go and do a 56.10 or 56, as long as it stays below this price, I can keep all that money collected. Or I buy 56.45 at $10 and I buy one contract. It goes to 56.80 or 56.90. I may make 400% or 300% on my call. But if it stays only at 56.45, you are losing the entire $1,000, right? You have a high chance to make profit here, but you will make only $200. You have less chance to make, but if it goes much up 56.70, 56.80 without staying choppy, you can make 300, 400%, but you will only buy one contract here. So again, based on the spread risk, what is the net risk based on your account size? If you take like this, you will be successful. But if you are buying 10 contracts here, you buy 10 contracts here, or you buy 20 contracts, 20 contracts here, then suddenly there is a bad news or something. Suddenly some news came out. Your entire account will get impacted because instead of taking one contract, you are using 80% of your account size in one trade. Suddenly Trump announces something, right? Even though right technical analysis based on that, it shows that it can go all the way to 57.20. But suddenly if there is some COVID news from China, some other new variant, or suddenly there is right something some tariff news on Mexico, China. They said they will wait for 1 month. Again, Trump decides that no, I don't want to wait. I will put it tomorrow itself. So then again, your entire account is lost in one trade. So that's why it is very important to understand what is your account size, what is 3% of each trade for the account size. Based on that, if you take the trades, you will be successful. But if you are just going big, right? Even though we make 8 out of 9 out of 10 trades, but you took only one trade because you are busy in a meeting during that time in all the other 9 trades. Now you got free. and you saw that oh, all the 9 trades made huge profits, let me go big. That one trade, because of some news, suddenly it turned in the opposite side. Then you lost that entire profits, or you might have even missed that 9 trades. Or you feel like, oh, this is a scam, right? This person is telling he is making profits, but I am losing. My account is going down, right? So we need to understand if the gap is, are we right? Are we doing this using 1K or 2K, 3K? When you use 2K, 3K, one MDB made 1000%. That means even if you have 10 losing trades, still you will be green. But if you are using 10 contracts, 20 contracts for everything, then even though you made profit on 90%, one trade where you had a loss, let us say the spread is very big, that only trade you lost, then it will take away all the gains you made. So if you can understand this simple process, if you can just follow, right, whether you are buying stocks or, right, if I want to buy 5 stock, right, okay, that is $2,000. 2000 divided by 75, approximately some 25 stocks. I'll buy, say, 25 stocks of 5. Like that, whether you are a stocks buyer, options buyer, all you need to do is, first thing is understand what is the trend. Second thing is understand what is the max you can allow for each trade. In that way, even if one trade goes wrong, 2 trades goes wrong, 3 trades goes wrong, still you will be profitable, right? Even out of 10 contracts, even if 5, 6 trades give you profit, 4 trades give you 100% loss, still you will be green. But when you don't use a proper position size, even though you win 8%, 8 trades, you lose 2 trades, you will be red at the end of the day. Right? That is the major common mistake by 95% of the retail traders, where you take one trade and you allocate very big position size for that. You allocate most of the capital for one trade, even though you win all the other trades, right? So again, if you go back, yeah, you can see that we made exit with 50%, 70% profit, 60%, 100% profit with SPX, NDX 100% profit. So we are making 85 to 90% profit. But are you using a consistent position size, or are you going with 10, 20, 20, 20, 20 for everything? If you go with 20, 20 quantity for everything, even though you have one loss, it may take away profit from all the other trades. But if you are going with 1K, 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 one big profit with MDB, one big profit with RDW, one big profit with UNG call, USO call, one big profit with SPX, or one big profit with, or one big loss will not impact your account. We had a loss with Adobe, but now you lost only 1K. Maximum you can lose 100%, right? Maximum you can lose 1,000. But if one trade goes well, it can make 5,000, $10,000, right? DocQ went 500%. So 1K became 5K. So that means 5 losing trades are compensated. Then everything else is green. You will be profitable. But if you are not using the proper position size, that is where the problems will happen, or the major issue will happen. If we go with, right, so just remember this, and if you follow this, you will be very successful. At the end of the week, you will be making some nice profits. I hope. Bull put means buy high, sell. No, bull put means you have to sell high, put, and low. So there are no assignment in the SPX. That will be complete cash settlement. So again, when you make right? Some of you may ask, oh, SPX, we are only collecting 100, but your risk is $500. But 90% of the time you will make money, right? 90% of the time you are collecting 100, $100. Suddenly there is some black swan event, some news, suddenly it drops. But your risk is only 1K. Cash settlement means there is no stock assignment, right? Whatever, that's what I said, right? If you got this 5610 put, right? Again, if you go back and see options premium, right? I said like SPX, NDX, this is the bear call for today. Collect $110 premium. 5605, 5600 bull put, collect $70. NDX, you can let them expire. That means if you let them expire, all that profit will credit to your account. SPX also we did, right? Keep 100% with SPX bull puts and NDX bear calls. That means because we are bullish for SPX, we got a bull put, collected $70. There is no SI, right? For stocks, sometimes you buy a call, you do a bull put, there can be a stock assignment. There is cash settlement means if you are in a profit, if SPX is staying above this, all that money is yours. Or if SPX goes below this price, that means you collected 70. That means you have to pay 430 from your account. Whatever is the remaining, $500 minus 70, 430. They will deduct $430 from your account if you buy one contract. If you did a bull put, right, when right around 205, you saw, right, where is SPX? SPX is somewhere around, it is very bullish, right? You can see that SPX was very bullish in all the time frames. Now you are at around 5640. And you see there are a lot of buyers here. There are buyers here, buyers here, buyers here. This is your previous day high, which will act as a strong support. So now we are doing a bull put somewhere here, right? You are going 40 points down because your trend is completely bullish in all time frames. Now around 2 o'clock when it is your price pulse is completely green, blue. Your T5 is green. This is still bullish. Now I am going, this is my support one, support two, support three, support four. I am going four levels down and I am taking a bull put. That means I am telling that our price will stay above 5600 by end of the day. So unless there is major bad news, your SPX will continue to stay, right? Yeah, I know there were 1 or 2 weeks where we had some big losses, where suddenly Trump was giving all sudden major news. But again, your risk is 90% of the time we are winning with our SPX, bull puts, bear calls, NDX, right? NDX, we saw that, right? NDX, it is around 19,700. And then there was a huge sell order block here. There is a $123 million sell order block, right? If you go to 5 minutes, you see that, you see there is a 48, 49 million sell order block. So now I went above this and did a bear call, right? In last 15 minutes. So either you go below this and do a bull put, or you go above the sell order block and do a bear call. That is, right, your risk is minimal. Or, right, if your trend is very bullish, you go, right, this is your support one, this is your support two, this is your support three. Right around 2 p.m., you go and do a bull put, right? Collect the credit. And then the chances for it to drop all right, break this level, this level, this level, right? Whenever price comes here, buyers will push it up. Whenever price comes here, buyers will push it up. Whenever price comes here, so now I'm going all the way down and doing bull puts here, right? Okay, I have a $1,000 risk. I'm collecting only $100 or $80, but the chance of winning is 90%, right? Every day the bad news may not happen. So that's why we went much below, did a bear call, or right here for SPX we did a bull put. For NDX we saw 50 million sell order block, and then we see that in 1 minute it is slowly turning to bearish, 2 minutes it is turning to bearish. That means sellers are slowly coming and doing a sell off. So we went and did a bear call somewhere here. We collected the money. For SPX we went and did a bull put here. We collected the money. So like that, whenever you see big sell orders, big buy orders, you can go below the buy orders and do bull puts. You go above the sell order, right? You can do bear calls. So if you are somewhere close, that is the best time, because when you are close to the right, buy order, you get a buy signal. If you do it at that time, you can collect 200, $300 on a $5 spread. That is the best time to buy it. But sometimes when you have only last 5 minutes, 10 minutes, and the chance for it to go right, already 1 to 3 minutes are looking bearish. So the chance of it going so much high in last 5 minutes is very, very less. So now you collected $100. So that is like a free money, because if it has to move 70 points within 5 minutes, again, I'm not saying that it is not possible, but the chances are very low. Right? Trading is all about that possibility, probability. The probability of it going above this 49 million sell order block is very, very minimal. So we went up and we did a bear call here. We went down for SPX. We went down and did a bull put here. So yeah, that's it. If we can just follow that, we will make nice profits. So the most important thing is, yeah, remember this. What is our account size, right? Whether it is a 50K account for stocks, 30K for options, whatever it is, right? Divide 3% for each trade, or divide 4% for each stock trade. Try to follow that position size. Whatever trade you are taking, bull puts, bear calls. If you want to take little more, if your setup is looking perfect, right? Let us look at one more. Um, Micron or PDD. So what do you think Micron can happen? Right? Where do you think maximum it can go for Micron? Do you think which one is better, right? Do you want to buy calls? Do you want to buy puts? Do you want to do bear calls? Which one seems to be a better option for this one? Where the risk is less? Yeah, most of you answered it right. So you can see a lot of sellers here, right? If I do a bear call above this, your risk is less, right? Again, on the day we can see the exact flow. But if you do bear calls here, right? Because if I do a bull put, immediately after earnings it may go up, but next day morning it may go down, because there are a lot of sellers here. It will go up and again by the next day morning it will drop. So instead of doing a bull put or buying a call, if I go here and do a bear call, right, above 116 or 120, i I sell 120 call, I buy 122 call, my risk is minimal. So again, if $2 spread, if I'm collecting $100 as a that, I can buy 10 contracts and I can do a bear call spread. So like that, you analyze that. Yeah, it seems that it will move up, but can it go so much high? Or because if there is already a premium, I can see a lot of sellers here. Instead of doing a call or debit call spread, doing a bull put, or right, instead of doing a bull put, bear call looks like a less risky approach as of now. Again, on right before the earnings, we can see more, right? If, for example, on the day you see more sell orders, then we can buy the puts. So yeah, exactly 30 40 minutes before we will get a perfect picture. But as of now, bear calls looks like a better option for this one. So by looking at this, you can analyze, okay, I can buy calls, I can do debit spreads, I can do bull put spread, I can buy puts, but you don't know whether it will go up and it may stay here. So if you buy the puts, also there is risk. If you buy the calls, it may go up, come down next day morning. So if you do bear calls, your risk is very, very minimal. Right? You go above the premiums, above the sell orders, so there is a high chance to make money. Right? Let's look at some other example. FedEx. Right? FedEx came nearly all the way to the bottom. Right? It is completely in a consolidation at the bottom now. So there is a high possibility for FedEx to go up. My reversal is telling that it came all the way, right? It was somewhere around, it went all the way to the top to $310. From 310, it came to 240. I got a strong buy. That means there is a high possibility for FedEx to go up. Now, if I go and look at price pulse, I see that it came all the way to the discount zone. This is at a bottom. So now, if I do a bull put here, your risk is minimal. Or if you want, you can go further down, do a bull put here. Your risk is very, very less. If I buy a call, yes, there is a possibility for it to go up. It may go all the way to 2. So I can buy a 240 call. I can sell a 260 call. I can do a debit spread. Or I can do a bull put, 230, 235 bull put and collect the premiums. So like this, you can watch, you can decide which is better and use the consistent amount rather than consistent quantity. That way you will be very, very successful. So yeah, that's it everyone. So FedEx earnings last time it was bad, but this time it can go up. Now it came all the way to the bottom. There is a high chance for it to go up. Now it is consolidating at the bottom. Whenever there is a lot of consolidation at the bottom, there can be a big move up. Whenever there is a big consolidation at the top, there can be, right. For example, you look at ES. You see a lot of consolidation at the top. Suddenly there is a big drop. Maybe there can be some consolidation at the bottom. Again, it will go huge. Right, copper. There's a lot of consolidation happening at the top. We can see a big drop in copper in next 1 2 days. You see a lot of consolidation. Right? Sellers are trying to bring it down, go up, buy it down, go up, go up. So finally it dropped so much. So same thing now FedEx. We can see a big move, huge move up. So that's it, right? All we need to do is look at confluence, look like what P5 is telling, price pulse is telling, reversal is telling. Then you will be in a right direction. You can make nice profits. And then you see there are sellers here. So FedEx may go until 260 and then drop. So either you can go and do a bear call above 260, 265, or you do a bull put below this. Then you will make profits. So yeah, that's it everyone. So this is how to take the trades. Second thing is, right, if you have indicators, how to analyze, how to take the trades, and also how to position size so that one loss should not impact all your profits. You are you are taking trades in such a way that even if 5 out of 10 trades make profits, you should be profitable at the end of the day. Because maximum you lose is 100%. but there is no limit for the gain. Right? You have If you have one good trade like DocU, MDB, or we have so many trades where we made 500, 600% on naked calls, naked puts. One good trade will take away losses from 4, 5 trades. So yeah, just follow it and then you'll be successful. Right? Yeah, thanks everyone for joining in, and I'll do more of swing trades from tomorrow because I understand some of you cannot quickly take and exit out. We'll do some more 1 or 2 day trades, but I'll also focus more on the swing trades so you can make some nice gains. Yeah. Okay, everyone. Talk to you later. Bye.